Hi everyone, this is Nick from TraderLion, and I just want to put together a short video. I know we've gotten some questions on risk management, fear of missing out, and a whole bunch of other things. So here's a quick video on trading psychology. I believe it is not given nearly the attention that it deserves, and this is really what separates the consistently profitable traders from everybody else. So let's get started. So this is based off the 5 fundamental truths from a book called Trading in the Zone by Mark Douglas. If you haven't read it, I highly suggest you read it. This book has changed my life. I've become a consistently profitable trader because of a lot of the values in this book, and they're very important. So, one, anything can happen. Two, you don't need to know what is going to happen next in order to make money. 3. There is a random distribution between wins and losses for any given set of variables that define an edge. 4. An edge is nothing more than an indication of a higher probability of one thing happening over another. And 5. Every moment in the market is unique. So number 1, anything can happen. If anything can happen, then you need to plan like anything can happen. Most traders put on trades with the expectations of it's going to work out. Nobody thinks of, oh, this trade might not work out. But the truth is, anything can happen. So you need to define your risk. If you're not defining your risk, you're not going to be consistently profitable. So you have to define your risk to what you accept based on your account size. So if you want to risk $50 a trade, $100 a trade, $1,000 a trade, it all depends on personal factors. But whatever risk you define, you need to accept that. You're not going to make money without losing money. The market is probabilities, and you're going to have to take losses with your wins, and you're just going to have to accept that. So you have to define your risk. If you're going to define your risk at $100, then you have to accept that you're going to lose $100. If your stops get hit, you lose that $100, then you've defined that risk and you were okay with it, and now you've accepted it. So this is one big component. If you position size and you want to risk $100 on a trade, and you find that stop loss hits and you feel upset, frustrated, or it was too much for you to handle, then lower that risk to $50 or respectively from wherever you started. But you truly need to accept that risk. So that brings us to 2. You don't need to know what's going to happen next. You want to go into the market with no expectations. If you have expectations and they're unfulfilled, they create emotional distress. You will interpret losses as negative, and negative thoughts will make you perceive the market as threatening. And this is a cycle that is very hard to get out of, and so you don't want to get in it. This is an emotional cycle. If you set expectations, you think that you have to be right, and when the trade goes wrong and you're proved wrong, your expectations weren't met. Now you have negativity towards the market, and the market's neutral. There's no positive or negative information coming from it. It's however you perceive it and use it. So this is just going to affect your entire psychology, and it's going to affect your overall trading. So this brings us to random distribution. The outcome of a set of trades is always random. So you need to think in probabilities. If you think in probabilities and your last trade was a loss, you'll look forward to the next occurrence of your trade without hesitation. What that means is that if you understand that losses come with your wins and you think in probabilities, you know you have an edge, then you getting stopped out of a trade isn't going to mean anything. You just know it's on to the next one. So what you don't want to do, the mindset you don't want to have if your last trade was a loss, you will hesitate on your next trade. So this brings us to FOMO, fear of missing out. If your fear of missing out is greater than the fear of losing, that's going to lead you to gather evidence for your trade. If your fear of losing is greater than your fear of missing out, then you're going to gather evidence against the trade. There's no guaranteed outcome. Anything can happen. So fear should not be an emotion. Whether it's fear of losing or fear of missing out, it's going to cause you to waste time gathering evidence, and you're going to hesitate moving on to your next trade instead of thinking with a clear mind. So what is your edge? An edge is just one outcome that has a higher probability than the other. But you need to remember that there's a random distributions of wins and losses. It only takes one trader anywhere in the world to invalidate any evidence that you have. And what I mean by that is when you get too emotionally involved in your trades, you can find evidence for the trade anywhere. You can find evidence against the trade anywhere. And all it takes, and what I mean by all it takes by one trader anywhere in the world, if you like a stock, you're going to buy that stock. You've put hours of research into that stock. And no matter how much you believe it's going to go up, all it takes is one really deep trader to sell 1 million shares and turn that around, and your trade's not going to work. So you really want to just focus on your edge, define your risk, and you want to act very mechanically, not emotionally. So that brings us to the last one. Every moment is unique. So from everything we discussed, if every moment is unique, why bother trying to know what will happen next? Set your risk and take the trade, and that's what it comes down to. You've identified your edge, you set your risk, and you take the trade. There's no emotions involved. And so to tie this all up, I've got an example here. I got the daily chart of MU, and this is from my personal broker. So I've identified my edge. You could see I don't have many indicators or anything on there. I've got my moving averages and my volume. All I use is price and volume. That's my edge, and I know how to use it. And so anything else would just be further evidence that would cause me to look way too much into trades when I already know what works for me. So here with MU, it's gone into a consolidation period for 10 weeks or so. And so if it's to break out of this period here on above average volume, the probability of it working is greater than the probability of it not working. Do I know if it's going to work? No, but the probability is there, so I set my risk and I place the trade. So I hope this video helped a bit with the basic fundamentals of turning from an emotional trader to a mechanical trader, because that is truly what separates the consistently profitable from the non-profitable in the market. So I will have further videos that go into more detail on specifics coming out shortly. But for now, hopefully this was a nice introduction into the trader's mindset. So thank you, and I will talk to you guys in the next videos.